If you're 25, 35, 45, and you look at your savings and it's basically nothing, there's a very specific kind of fear that hits you right in the chest. It's not just, I wish I had more money. It's the thought you try not to say out loud. What if I did everything right, worked for decades, and still end up broke? And here's what makes it even worse. When you feel behind, you become vulnerable to the most dangerous move in investing, trying to catch up fast. That's how ordinary people turn a temporary setback into a permanent financial wound, not because they're dumb, because they're scared. So in this video, I'm going to give you a calm, Benjamin Graham-style road to your first $100,000, especially if you're starting late, starting small, and you don't want hype. A simple, defensive plan that doesn't require predicting the market, doesn't require finding the next big thing, and doesn't require you to gamble your future. Because the first 100K isn't just a number. It's a turning point. It's the moment where your money starts to feel like it has weight, like it can actually carry you, but only if you reach it without getting wiped out on the way. And yes, this video is for educational purposes, not personal financial advice. Now, why is this topic so dangerous for ordinary investors? Because when you have almost no savings, you don't have a cushion. You don't have room for big mistakes. A person with $600,000 can survive a bad decision and recover. A person with $6,000 can get set back for years by one emotional trade. And that's why Benjamin Graham's work still matters so much. Graham wasn't trying to help you impress people at a party with stock tips. He was trying to protect you. He divided the world into investors and speculators, people who behave like owners of real businesses, and people who behave like gamblers chasing price moves. He talked about building a margin of safety, like an extra thick bridge that still holds even when the weather turns ugly. And he gave us the mental model of Mr. Market, the moody business partner who shows up every day offering to buy from you or sell to you at whatever price his emotions produce. Your job isn't to follow his mood. Your job is to use him. So let's place you in the real story. You work hard. You pay rent or a mortgage. You deal with groceries, insurance, maybe kids, maybe family obligations. You try to save, and then life happens. Car repairs, a medical bill, a job scare, a surprise expense. And in quiet moments, you do the math and realize if nothing changes, retirement is not a plan. It's a question mark. So you open your phone, you see people online turning a few thousand into millions, and the temptation shows up. Maybe I just need one big winner. This is the fork in the road. One path is emotional, fast, and exciting. The other is boring, slow, and safe. And the safe path is the one that actually works for ordinary people. Before we build the road, we need to diagnose the trap. Because the people who stay broke usually don't stay broke because they never invested. They stay broke because they invest in a way that keeps resetting them back to zero. Here's the pattern. When you're behind, you feel urgency. Urgency creates impatience. Impatience creates risk. And risk, without skill, without discipline, and without margin of safety, creates permanent losses. Let me make it vivid. Imagine you're 39. You've got $8,000 saved. You finally start investing because you're tired of feeling helpless. Then the market drops. Maybe it's a recession. Maybe it's a panic. Maybe it's just a normal, ugly year. Your account goes down 25%. That $8,000 becomes $6,000. On paper, that's only $2,000. But emotionally, it's a month of rent. It's a car problem. It's the emergency you didn't have. So what do? A lot of people sell. Not because they're irrational in general, because they're trying to protect their life. Then, after they sell, the market eventually recovers, but they're out. They don't re-enter until it feels safe, which usually means after prices are higher again. So they locked in the drop, missed the recovery, and taught their brain one lesson: investing is dangerous, and they stop. Or they try a different mistake. They chase what's hot. They see a stock that doubled. They hear a story, a narrative, a promise. They buy because it feels like a shortcut. And in Graham's world, that's the moment you stop being an investor and start being a speculator, because the decision is driven by price movement and emotion, not by value and safety. Then the story changes. The stock collapses, and the small portfolio, the fragile portfolio, takes the hit that a large portfolio might survive. That's how people turn temporary volatility into permanent damage. And it's not just the money. It's the loss of confidence. It's the voice in your head that says, "I'm not meant for this." Now, here's the Graham lens that flips everything. Graham would tell you the stock market is not a slot machine. It's a place where ownership interest in real businesses get traded at emotional prices. Price is what people pay when they're excited or scared. Value is what you get when you own a piece of a business that produces cash over time. Most beginners try to predict price. Graham taught you to respect value and to demand a gap between the two. That gap is your margin of safety. If you're starting with almost no savings, you need that margin more than anyone, because you don't have the luxury of being wrong. And here's the part most people miss. Your first goal is not maximum returns. Your first goal is not getting knocked out. In boxing, you don't win by swinging wildly in round one. You win by staying on your feet, protecting your head, and letting the other person make mistakes. Investing is the same. The first $100,000 isn't built on genius. It's built on survival and consistency. So what does the road actually look like? I'm going to give you 5 rules, 5 moves, not flashy, not exciting. But if you apply them, you stop leaking money through panic, you stop resetting to zero, and you build your first $100K on a foundation that can hold real wealth later. The first rule is simple, and it's the one people avoid because it doesn't feel investing enough. Stop the bleeding before you chase growth. In real life, this looks like investing while you're drowning. You're putting $200 into the market while carrying a credit card balance at 20% interest. You're buying stocks while one car repair would force you to sell at the worst time. That is not a plan. That is financial stress wearing an investing costume. Why is it dangerous, Gramps? Because it destroys your ability to behave rationally. Graham's whole philosophy assumes you can act like an owner, not a desperate seller. But if you're one emergency away from panic, you don't have the option to be patient. So the intelligent alternative is boring and powerful. Build a small margin of safety in your personal finances first. A starter emergency fund, not 6 months if that feels impossible right now. Start with a target that changes your behavior. $1,000, then 1 month of expenses, then 2. The goal is not perfection. The goal is to stop being forced to sell. And if you're carrying high interest debt, treat it like a guaranteed negative return. Paying it down is not missing out. It's buying back your freedom to invest without fear. That's rule 1. Stabilize the base so your investing decisions aren't made under threat. Now, the second rule is where the real road begins. Make your savings rate the engine, not your prediction. When people feel behind, they obsess over what to buy, what stock will go up, what sector is next, what's the secret. But for your first $100K, the bigger lever is often how much you consistently add, especially early on. In real life, this looks like someone depositing whatever is left over at the end of the month, which is usually nothing. So they invest randomly, then wonder why nothing. Graham would call this a behavioral problem, not an intelligence problem, because the market rewards discipline more than it rewards excitement. The intelligent alternative is to reverse the direction of money. Pay yourself first, automatically, even if it's small, especially if it's small, because you're not just building money, you're building identity. You're becoming the kind of person who invests every month, whether the mood is good or bad. A simple rule: decide on a percentage, not a feeling. If you can start with 5%, start with 5%. If you can do 10%, do 10%. If you can't do a percentage, do a fixed number and increase it every time your income rises. And here's the calm truth: you don't need a heroic savings rate to start. You need a consistent one. Consistency is how you stop the start-stop cycle that keeps people stuck. That's rule 2, automate the engine. Third rule, and this one is pure Graham in spirit: build a defensive portfolio before you try to be clever. Most people starting late think they need to be aggressive. They think safety is something you earn later. But Graham would flip it. If you're an ordinary investor, you start defensively. Defensive does not mean no stocks. It means you don't take risks you can't understand. You don't take risks you don't get paid for, and you don't take risks that can wipe you out. In real life, this is where people get lured into concentrated bets. They put half their money into one stock because it feels like conviction, or they load up on the most exciting theme because everyone is talking about it. And when it drops 60%, they don't just lose money, they lose time. They lose the habit. They lose the belief that this works. Graham's logic is simple: the future is uncertain, so you don't build a plan that requires certainty. So what's the intelligent alternative? A diversified, low-cost core that you can hold through bad years without abandoning it. For many ordinary investors, that means broad, diversified funds as the foundation, so your outcome isn't dependent on one company, one story, or one headline. And it means an allocation, your mix of stocks and safer assets that you can actually tolerate, because the best portfolio on paper is worthless if you abandon it in panic. You don't win by choosing the portfolio with the highest possible return. You win by choosing the portfolio you can stick with. That's defensive investing. It's not about bravery, it's about durability. And yes, it's less exciting. That's the point. Rule 3, diversify your risk and build a portfolio your nervous system can survive. Now, the fourth rule is the one that ties directly to the first 100K. Use Mr. Market to your advantage with steady buying, not emotional timing. Most people think investing is about buying at the perfect moment. They wait for the bottom. They wait for clarity. They wait until the news stops being scary. But Mr. Market doesn't ring a bell, and the moment it feels safe is usually the moment prices are already high. In real life, this looks like you saying, "I'll start investing when things calm down." Then months pass, years pass, and the cost isn't just returns. The cost is momentum. Graham's model of Mr. Market is so useful here. Mr. Market is manic one day, depressed the next. He offers you prices, and he begs you to react. The intelligent investor doesn't obey him. The intelligent investor has a policy. So the alternative is straightforward: dollar cost averaging with a rational rule. You invest on schedule, every paycheck or every month. When prices are high, you buy fewer shares. When prices are low, you buy more shares. And emotionally, it feels backward, because buying when things look ugly feels uncomfortable. But that discomfort is often the whole advantage. This is how ordinary people turn volatility into a friend. not by being fearless, by being systematic. And if you want to add a simple Graham-style layer of discipline, rebalance occasionally, not daily, not obsessively, just enough to prevent your risk from drifting. When stocks soar, your stock portion grows. When stocks crash, it shrinks. Rebalancing quietly forces you to trim what got expensive and add to what got cheaper. That's not prediction, that's policy. Rule 4, stop trying to be a hero. Be a machine. Now, the 5th rule is the one that protects the entire journey. Do not confuse a good story with a good investment. If you remember only one rule from this video, make it this one. Because when you're behind, stories become irresistible. Stories promise you a shortcut. They promise you relief. They promise you can skip the slow part. And the market is filled with people eager to sell you relief. In real life, this is how it happened. You see a chart that went straight up. You hear, this time is different. You hear about a revolution, a new era, a guarantee, a once-in-a-lifetime opportunity, and then you buy, not because you evaluated value, but because you wanted to stop feeling behind. Graham would call that speculation, not as an insult, as a category. You are paying a price based on excitement, not based on a conservative estimate of what you're getting. And when you overpay, you shrink your margin of safety. When the mood shifts, and it always shifts, you're exposed. So the intelligent alternative is to adopt a filter that blocks most temptation. Before you buy anything, ask, do I understand what I'm buying? Is it diversified enough that one mistake won't ruin me? Am I paying a reasonable price for the value I'm getting, or am I paying for a dream? And if you can't answer those calmly, you don't buy, because your goal is not to participate in every trend. Your goal is to reach 100K intact. Rule 5, protect your future from exciting stories. Now, if you follow those 5 rules, what does your road actually look like in practice? Let's turn this into an action plan you can follow starting this month. First, create your anti-panic buffer. If you have no emergency fund, start one, even small. You're not doing this to get rich. You're doing this to avoid selling investments when life hits. Second, choose one number and one date. One number, the amount you invest every month. One date, the day it happens. Automate it. Remove the decision. When you make investing optional, your emotions will eventually vote no. Third, build a simple defensive core, a diversified foundation that doesn't require constant decisions. Low cost matters because fees quietly eat compounding. Diversification matters because single bets create single points of failure. If you want to be enterprising later, more active, more selective, earn that later. Start defensively. Fourth, adopt a 2-sentence policy for bad markets. Write it down. Seriously, something like, when markets fall, I keep investing on schedule. I do not sell from fear. I rebalance based on my plan. That's not motivation. That's a rule you follow when motivation disappears. Fifth, set a no entertainment investing rule. If you want to learn about individual stocks, great. Study, read, take it seriously. But do not let your retirement depend on what's trending this week. If you ever feel the urge to buy because you're excited or desperate, pause. That feeling is not a signal. It's a warning. And now let's deal with the emotional reality you're living with. Because you might be thinking, okay, but I'm so far behind. Is this really enough? Here's the calm answer. The road to the first 100K is not one decision. It's a season of decisions. It's the season where you stop trying to win quickly and start refusing to lose. And that alone changes everything. Because once you're consistent, you stop relying on willpower. Once you're diversified, you stop relying on one outcome. Once you have a buffer, you stop being forced to sell. And once you stop chasing stories, You stop donating money to the market at the worst moments. That's how you build the first 100K, not with brilliance, with protection. Now, a quick reality check with simple numbers, just to anchor your expectation. If you invested $500 a month, that's $6,000 a year. Over several years, with reasonable long-term market returns, you can build meaningful momentum. If you can increase that monthly contribution as your income rises, even slowly, the timeline compresses. But the point isn't the exact math. The point is that the plan works if you keep showing up. Most people don't fail because the plan is flawed. They fail because they stop. They stop after a bad year. They stop after a scary headline. They stop because they tried to be clever and got punished. So let's reinforce the identity shift that makes this sustainable. From now on, you're not a person trying investing. You're becoming an intelligent investor. That means you don't need to be right about the next 6 months. You need to be reasonable over the next 20 years. It means you don't measure success by excitement. You measure it by resilience. It means when Mr. Market panics, you don't panic with him. You quietly keep building ownership in productive assets at better prices. Most people will keep doing what the crowd does. They'll buy after things feel safe and sell when fear becomes unbearable. They'll chase what already went up and abandon what went down. They'll turn volatility into a personal trauma. And then they'll say, investing doesn't work. But you're not trying to be most people. You're trying to be free. And freedom, in Graham's world, is built with patience, margin of safety. It's built with boring consistency. It's built by refusing to make the same expensive emotional mistakes. So, if you're 25 to 50 with almost no savings, hear this clearly. You are not doomed, but you also can't afford to be reckless. You don't need a miracle. You need a road that keeps you from blowing up your progress, a road that turns anxiety into a system, a road that gets you to the first 100K without gambling the decades of your life it took to earn those dollars. And once you cross that line, it shifts because money starts to compound. But even more importantly, your confidence compounds, your discipline compounds, your identity compounds. Now, if you want more calm, rational, Graham-style guidance, subscribe. And if this video hit your situation, like it and comment with one word, road. Not to hype it up, just to commit publicly that you're done chasing shortcuts. And the next video you should watch is the one that makes this plan even stronger. How to build a crash-resistant portfolio so that when the market eventually drops 30% or more, you don't freeze, you don't sell, and you don't destroy your future. The goal isn't to avoid every storm. The goal is to build a structure that survives storm while everyone else panics. That's intelligent investing. That's the road. And that's how ordinary people reach the first $100,000 the safe way.